Welcome back to the Deep Dive, where we break down complex earnings calls into what you really need to know.
And today we're talking about a retailer that made some serious waves right before the Thanksgiving holiday.
That's right, Petco. Ticker, oof.
We are zeroing in on their FY2026 Q3 earnings call, which was after the market close on November 25th.
And our mission today is to really get under the hood of this one, to see what management actually fixed, why the market reacted so strongly, and if their big growth plans for 2026 are actually believable now.
Yeah, because on the surface, the numbers looked a bit mixed.
They really did.
Yeah.
I mean, you look at the filing, and net sales were about $1.46 billion.
Right, which was a miss, slightly below consensus.
And it's a year-over-year decline of 3.1%. So the top line is definitely feeling the pressure.
For sure. But that was, completely overshadowed by what was happening underneath.
It was all about the bottom line. This was a story about operational focus, about execution.
A classic profitability story. And the market, well, it rewarded them for it almost immediately.
Let's put that surprise into context, because the numbers themselves are pretty startling.
They really are. So non-GAAP adjusted earnings per share, that's the number everyone watches. It came in at roughly 5 cents.
5 cents. And the Zacks consensus was what?
Just 1 cent.
Wow.
So that's a 400% beat. I mean, when a company outperforms by that much, it's not just a win. It tells you management has a real grip on the business. It just injects a ton of credibility into everything else they say.
And the margin story backed that up completely.
Oh, absolutely. Adjusted EBITDA landed at $99 million. That's up 21% year over year.
Which also beat expectations, right? The street was at 95 million.
Exactly. It pushed the EBITDA margin up to 6.7%. And what's crucial is that they did this even with comparable sales declining 2.2%.
So they're still facing that cautious consumer, but they found a way to be more profitable anyway.
Precisely. The big takeaway is that Petco made a strategic choice here.
They sacrificed some of those low-quality sales.
Right, in favor of operational rigor and better margins. And the market absolutely endorsed that decision. They focused on the quality of the earnings, not just the quantity of revenue.
And management kept talking about phase 2 of their turnaround.
Yes, which they define as rebuilding the economic model of the business before they try to flip the switch back to growth.
Okay, so let's dig into the mechanics of that. What were the specific drivers behind that big margin uplift? How do they pull that off?
So gross margin expanded by 75 basis points up to 38.9%.
And 75 basis points? I mean, that's nearly a full percentage point. That's a huge deal in retail.
It is. They said it came from a much more disciplined promotion strategy, a better product mix, so selling more high-margin stuff, and real supply chain savings.
I think the CEO called them empty calorie sales that they were cutting out.
That's the term, yeah. Sales that basically didn't help the profit picture at all.
And that discipline flowed right down the income statement. I mean, the SG&A control, the selling, general, and admin expenses, that seems like the other critical piece here.
It was huge. Operating margin expanded by about 170 basis points, landing at 2%. And that was mostly because SG&A expenses fell by $32 million year over year.
That's pure operational leverage.
It is. They're just squeezing more profit out of a leaner expense base.
But, when you see aggressive SG&A cuts like that, it can be a red flag. Sometimes those cuts aren't sustainable. They can hurt the customer experience. Did they talk about that?
That's a great question, and they did. They said it wasn't an across-the-board cut. It was targeted.
So not cutting staff in the stores.
Exactly. More about optimizing corporate overhead, streamlining IT, getting better terms from vendors. They're arguing that these are structural, permanent cost reductions that create a more stable foundation.
And this focus also extended to the balance sheet, cash flow, inventory.
Absolutely. Inventory was a huge success story this quarter. They cut levels by 10.5% year over year.
Okay, but here's the key part. Did that hurt availability?
That's the thing. They claimed they did it while increasing in-stock availability for customers.
So that's just pure efficiency.
Right. And that efficiency drove free cash flow for the quarter to $61 million. Year to date, their cash flow from operations has almost doubled to $161 million.
And that cash gives them options.
The main option being debt reduction. They confirmed that's the #1 priority for any excess cash right now.
They started the year pretty leveraged, didn't they?
Yeah, their net debt to adjusted EBITDA ratio was over 4 times, which is getting into a restrictive zone. Now they're on track to get that below 3.5 times by the end of the year.
And getting under 3.5x is a big psychological win with creditors and investors.
It is. It validates the whole self-help story. It proves they can deleverage the company on their own.
So phase 2, the fixing phase, is clearly working. But, at the end of the day, Petco is a retailer. Investors need to see growth.
Right. And management was very clear that they're now shifting resources toward phase 3, which is a targeted return to growth in fiscal 26.
And they laid out 4 pillars to get there.
They did. And what's really fascinating is how they're planning to leverage their biggest unique asset.
Which is their services business. Grooming, vet care. That's always been their moat against Amazon or the big box stores.
Precisely. It's high touch, it's in person, it's hard to replicate online. And they said it's now their fastest growing category. Vet hiring is ahead of schedule and retention is at record levels.
And they gave this really concrete example of what true integration between services and retail can look like. This is where the data comes in.
This is the aha moment for the whole strategy. They explain that soon their in-store vets will have access to a customer's entire purchase history.
Okay, so the vet does a checkup.
Right. The vet does a checkup, sees the pet needs a specific diet, and can instantly recommend a high-margin specialty food based not just on the checkup, but on what the owner has been buying for years.
So it connects the vet visit directly to a profitable sale right there in the store. It bridges that gap between the two sides of the business that were always kind of siloed.
That is the entire point. It makes the customer journey seamless and, for Petco, highly profitable. It just knits the whole thing together.
Now, on the merchandising side, they talked about shifting from being just a set it and forget it business.
Just focused on replenishing needs-based items like a 40-pound bag of dog food.
To something that drives discovery and excitement, this wants-based purchasing idea.
Yes, they're trying to inject a bit of a fast fashion mentality, and the best example is their impulse product line, My Human. It was a hit online, and now they're rolling it out to over 200 physical stores.
So you come in for the dog food, but you leave with a high-margin dog toy or a sweater that you didn't know you wanted.
Exactly. It drives up that average basket size by encouraging emotional, discretionary spending.
And then finally, the omni-channel piece is getting a big refresh.
It is. They're piloting a new membership program in Q4 to drive loyalty. And at the same time, they're overhauling their media buying and bringing back their classic tagline.
Where the pets go.
That's the one.
So with all this confidence, they actually raised their guidance for the year, even with the soft sales.
That's right. They still see full-year sales declining 2.5% to 2.8%, acknowledging the macro environment. But they significantly raised the floor on their adjusted EBITDA guidance to between $395 and $397 million.
Okay, but if Q3 was so strong at $99 million, why guide Q4 EBITDA sequentially lower to between $93 and $95 million? That seems a little odd.
It does, but it's actually a strategic choice, which is what makes it so interesting. They said, first, there are some higher tariff impacts in Q4. But second, and this is the key, banking all that profit in Q3 gives them the option to selectively invest back into the business.
Ahead of the big 2026 growth push.
Exactly. In labor, in marketing, in new inventory. It's a deliberate choice to set the stage for next year's sales without blowing up the full year profit target.
And the market loved it. I mean, the stock closed up, 14.5% the next day? On 5 or 6 times normal volume. That's real conviction.
It was a powerful endorsement, but we do need to add some context. That rally was a reward for the self-help, for proving they could cut costs and fix their own model. It was not an endorsement that the whole pet category is suddenly booming again.
Right. So the stock is still way down over the past year.
Way down. The sector backdrop is still tough. So Petco's story right now relies almost entirely on their own internal execution.
So investors are rewarding the cost discipline now, but they're still skeptical about the 2026 growth story.
Deeply skeptical. Management is saying growth is coming back. The stock's low valuation says the market is assigning a very low probability to that promise until they see hard proof.
All right. Now, this next segment is purely conceptual. It is for entertainment and discussion only. We are talk tickers, and this is not financial advice segment. We're going to pitch an outrageous but plausible trade idea.
Okay, so based on everything we just talked about, the thesis here is that the market is undervaluing how certain the self-help part of the story has become. So the pitch is a strategic long position long the stock, combined with some long-dated call options.
Okay, lay it out. Why that specific structure? What's the catalyst?
The core idea is that management has now earned its credibility. They delivered the EPS beat, they expanded margins, and they have a clear path to get leverage below 3.5x. That all creates a pretty solid floor for the stock.
So the stock itself provides the base.
Right. And we're betting on that successful transition to phase 3, the return to actual sales growth, which, As we said, the market is heavily discounting.
So how do the options play into that?
You use long-dated calls, maybe out to late 2026, to capture the potential for a really powerful re-rating. There are two ways this could play out. First, there's a lot of short interest in the stock. Any sustained good news could trigger a massive short squeeze.
And second?
Second, and more fundamentally, if they can show that the growth initiatives are working in the first half of 2026, the new membership program gets traction, the My Human stuff sells well, the entire narrative shifts
It goes from being a deep value turnaround story.
to a growth story with proven operational efficiency. And that kind of shift triggers a complete re-rating. It lifts the whole valuation. The options are there to capitalize on that explosive potential while the long stock position is based on the solid floor they've already built.
So it's a bet that the competence they just showed on the cost side will translate directly to the growth side.
It's a high conviction bet on exactly that.
Fascinating. And that really brings us to the close of this deep dive. Q3 was, without a doubt, a profitability win. They secured the foundation.
They absolutely did. But here's the provocative thought we'll leave you with. Management made a point of saying they now have the option to invest those profits in Q4 to set up 2026.
Right.
So the question is, can they successfully shift those resources back into growth, into marketing, labor, new products, without sacrificing the hard-won margin discipline they just proved they have? What's the breaking point between investing for growth and maintaining the rigor the market is rewarding them for right now?
That tension is going to be the single most important thing to watch in their 2026 outlook. Thanks for joining us for this deep dive. We'll catch you next time.